Welcome to the lecture on inventory management and control, and after this lecture we will be able to learn the following objectives. Understand objectives and function of inventory management system, explain nature and importance of inventory management system, define inventory cost, explain inventory classification system, describe ABC analysis, discuss EOQ model, explain economic production quantity model. Let's start with what inventory system is. Inventory is a stock of any item or resource used in an organization. An inventory system is a set of policies and controls that monitor levels of inventory and determine what levels should be maintained, when stock should be replenished, and how large orders should be. By convention, manufacturing inventory generally refers to items that contribute to or become part of a firm's product output. Manufacturing inventory is typically classified into raw materials, finished products, component parts, supplies, and work in process. The basic purpose of inventory analysis, whether in manufacturing, distribution, retail, or services, is to specify when items should be ordered and how large the orders should be. Many firms are tending to enter into longer-term relationship with vendors to supply their needs for perhaps the entire year. This changes the when and how many to order to when and how many to deliver. Inventory management is primarily about specifying the size and placement of stock goods. Inventory management is required at different locations within a facility or within multiple locations of a supply network to protect the regular and planned course of production against the random disturbance of running out of materials or goods. Inventory, to many small business owners, is one of the more visible and tangible aspects of doing business. Raw materials, goods in process, and finished goods all represent various forms of inventory. Each type represents money tied up until the inventory leaves the company as purchased products. Balance inventory. Inventory management system track a wide variety of quantities of stock. Inventory is tracked regarding inventories in stock items that should be ordered in higher quantities and adequate inventory turnover. Volume purchases are often used to ensure lower prices for frequently purchased items. Purchasing plan. Inventory management system track when an order should be placed, when inventory is at peak volume, the receipt of deliveries of inventory, and the anticipated date to order more stock. Analysis of the inventory system purchasing plan can provide information as to which items are not being used and should no longer be ordered. Inventory control. Different types of inventory control methods can be used to manage inventory. Businesses may be used as a ticker controlled system in which staff counts a portion of the inventory on a regular basis to determine inventory levels. Alternatively, a click sheet control system uses a paper record keeping system to keep track of inventory levels, while stub control is based on the retention of sales receipt to track inventory flow. Let us now understand the objectives and function of inventory management system. An inventory control system operates on the technological basic. It updates automatically every time an item is scanned and removed from the inventory, so the employer knows how much is on location at all times. The objectives of inventory management can be explained in details as to ensure that the supply of raw materials and finished goods will remain continuous so that production process is not halted and demands of customers are duly met. To minimize carrying costs of inventory, to keep investment in inventory at optimum level, to reduce the losses of theft, obsolescence and wastage, etc., to make arrangement for sale of slow-moving items, to minimize inventory ordering costs. Function. This is important as each item is valuable and essentially an asset for the company and the employer. An inventory control system functions to protect these assets and provide a cost-effective inventory control solution for the employer. Update as needed. An inventory control system is updated automatically through a scanning process. If an item or raw material is removed from the inventory, it needs to be scanned so the system updates. It is the same process if the items in the inventory are ready for sale. Once the item is scanned upon a customer transaction, the technological system updates the items in the inventory. Low inventory stock. The inventory control system will also provide the employer with updated numbers in regards to inventory stock available. This is particularly important for stores or raw materials used for product development. The figure gives information about when new supplies need to be ordered. Print detailed reports. The inventory control system should also provide the employer with a detailed inventory report that shows the activity surrounding the inventory. The reports how, when an item was removed from the inventory by scanning and how many items are left. This information allows the employer to determine whether inventory items are being stolen from the business. Save time and money. Another function that the inventory control system has is the ability to save the company time and money. Without a technological inventory system, the employer must often sacrifice both time and money by asking employees to work overtime to counting inventory items. This is done to get exact figures of what is available in the inventory, including broken or destroyed inventory items. Now moving on to the next topic, we will now study the nature and importance of inventory management system. Inventory management is an important part of a business because inventories are usually the largest expense incurred from business operations. Nature of inventory management system. Inventories are necessary for a firm to operate efficiently, and almost all business transactions involve the delivery of a product or service in exchange for currency. For this reason, inventory management is a very important part of core operation. Most retail businesses and wholesale organizations acquire most of their revenue through the sale of merchandise inventory. In order for business and supply chains to run effectively and efficiently, they must meet all the listed requirements for effective inventory management. Importance of inventory management system. Inventory management is an important part of a business because inventories are usually the largest expense incurred from business operation. Most companies will use an inventory management system that will track and maintain the inventory required to meet customer demand. Inventory orders. Inventory management system help businesses order inventory by accurately recording consumer sales. Electronic inventory system can track sales in a real-time format, ordering inventory automatically when current stock hits a predetermined minimal level. Electronic ordering, known as electronic data interchange (EDI), allows companies to maintain the proper amount of stock by not increasing costs through over-ordering of inventory. EDI also ensure that orders are placed immediately, ensuring short amounts of lead time to receive new inventory. Stock maintenance computerized inventory management system allow companies to properly order and maintain several different types of goods. Different styles, colors or sizes can easily be managed to ensure that consumer demand is met through offering a variety of goods. Most companies use inventory management to keep stock items separate from similar goods. This allows management to determine which items are selling well and which items need to be reduced from inventory based on poor sales. Price levels. Properly managing goods is largely based on the cost of the goods incurred by the business. Using inventory management system will help companies find the lowest price on inventory items and ensure that the best deals are reached when purchasing these items. Purchasing goods by volume also helps companies to lower their costs on inventory, ensuring that low prices are assured to consumer. Count methods. All inventories need to be counted and reconciled to the information provided by inventory management system. Computerized system will generate current inventory reports for management to use when conducting physical counts of in-hand inventory items. These items will prepare reports showing the current sales or transfer of inventory to allow management to track, sold or move goods. Trend analysis. A great function of inventory management system is the trending analysis that are generated for management review. These trends are used to see which months have high inventory levels or the effectiveness of inventory purchases.
How is your business doing, Melissa?
Things are very busy. Even with the bad economy, we have increased sales by 50% from last year.
That's great.
Yeah. But we still have a lot of problems getting our products to customers on time and finding the inventory in our warehouse. Our warehouse manager never knows when to place orders.
Sounds like you need a new warehouse manager.
No, Tony, I don't think so. I know my warehouse manager is a very hard worker and he is a smart guy.
Well, what are you using to track your inventory?
We use a really advanced spreadsheet that our warehouse manager made in Excel. It worked great up until we had to hire more people to help him. Now it's a hassle keeping everything updated and accurate.
Well, maybe you need a real inventory management system for your warehouse.
I've thought of that, but I don't think we can afford one right now.
I use an inventory management software called Fishbowl Inventory. It cost me less than 1/3 of the other solutions I was looking at, and it works great. We now have 3 warehouses and over 20 people using the software.
How is it so cheap? It can't do everything I need.
Fishbowl is cheaper than other solutions because it integrates with QuickBooks. So, you don't have to pay for a new accounting system. Fishbowl keeps your warehouse employees out of QuickBooks so you don't have to worry about an accounting nightmare.
That sounds great.
Yeah, Fishbowl is well worth the investment. We use it for all of our order management processes, and we scan inventory in and out using barcode readers. Fishbowl even lets us know when it's time to reorder specific products.
How can I learn more about Fishbowl?
You can visit their website at fishbowlinventory.com. On their website you can set up a personalized web demo and get a free trial of the software.
Purposes of inventory. All firms including JIT operation keep a supply of inventory for the following reason: to maintain independence of operation. A supply of materials at a work center allows that center flexibility in operation. For example, because there are costs for making each new production setup, this inventory allows management to reduce the number of setups. Independence of workstation is desirable on assembly lines as well. To meet variation in product demand. If the demand for the product is known precisely, it may be possible, though not necessarily economical, to produce the product to exactly meet the demand. To allow flexibility in production scheduling, a stock of inventory relieves the pressure on the production system to get the goods out. This causes longer lead times while permit production planning for smoother flow and lower cost operation through larger lot size production. To provide a safeguard for variation in raw material delivery time. When material is ordered from a vendor, delays can occur for a variety of reasons. Normal variation in shipping time, shortage of material at the vendor's plant causing backlogs, an unexpected strike at the vendor's plant or at one of the shipping companies, a lost order or a shipment of incorrect or defective material. To take advantage of economic purchase order size, there are costs to place an order, labor, phone, calls, typing, postage and soon. Many other domain-specific reasons. Depending on the situation, inventory may need to be carried. Now we will discuss the inventory cost. The cost of holding goods in stock expressed usually as a percentage of the inventory value. It includes capital, warehousing, depreciation, insurance, taxation, obsolescence and strengthening costs. Inventory costs are basically categorized into 3 headings: ordering costs, carrying costs, storage or stock out costs, cost of replenishment. Ordering cost. Cost of procurement and inbound logistic costs form a part of ordering costs. Ordering cost is dependent and varies based on 2 factors: cost of ordering excess and the cost of ordering too less. Both these factors move in opposite direction to each other. Ordering excess quantity will result in carrying cost of inventory, whereas ordering less will result in increase of replenishment costs and ordering costs. Carrying costs. Inventory storage and maintenance involves various types of costs, namely inventory storage costs, cost of capital. Inventory carrying involves inventory storage and management either using in-house facilities or external warehouses owned and managed by third-party vendors. In both cases, inventory management and process involves extensive use of building, material handling equipments, IT software application and hardware equipments coupled managed by operation and management staff resources. Inventory storage costs. Inventory storage costs typically include costs of building, rental and facility maintenance and related costs. Cost of material handling equipment, IT hardware and application including costs of purchase, depreciation or rental or lease as the case may be. Cost of capital includes the cost of investment, interest on working capital, taxes on inventory, paid insurance costs and other costs associated with legal liabilities, the inventory storage costs as well as the cost of capital are dependent upon and vary with the decision of the management to manage inventory in-house or to outsource vendors and third-party service providers. Let's know the meaning of inventory classification system. Inventory is a necessary evil in any organization engaged in production, sale or trading of products. Inventory is held in various forms including raw materials, semi-finished goods, finished goods and spares. Every unit of inventory has an economic value and is considered an asset of the organization irrespective of where the inventory is located or in which form it is available. Even scrap has residual economic value attached to it. Depending upon the nature of business, the inventory holding patterns may vary. While in some cases the inventory may be very high in value, in some other cases inventory may be very high in volume and number of SKU. Inventory may be held physically at the manufacturing location or in a third-party warehouse location. Inventory controllers are engaged in managing inventory. Inventory management involves several critical areas. Primary focus of inventory controller is to maintain optimum inventory levels and determine order or replenishment schedules and quantities. They try to balance inventory all the time and maintain optimum levels to avoid excess inventory or lower inventory, which can cause damage to the business. ABC stands for Always Better Control. The items on hand are classified into A, B and C types on the basis of the value in terms of capital or annual dollar usage, that is dollar value per unit multiplied by annual usage rate, and then allocates control efforts accordingly. Thus, items with low value and high volume are kept in C type and the items with moderate value and moderate volumes belong to the B type. A-type items are given the maximum attention while ordering for purchase and C-type the least. The ABC inventory control method determines the importance of inventory items based on usage, sales or cost criteria. This inventory control method provides companies the ability to give individual stock keeping units, SKUs, different levels of inventory control based on the SKU's relative importance. Companies perform a pair-to analysis to determine ABC item classification. Advantages of ABC analysis. Activity-based costing or ABC is a method of allocating overhead and direct expenses related to the most important activities of the company first. This process allows business owners and managers an opportunity to better define the areas of manufacturing or sales that generate the most profit of the company. Control. Utilizing the ABC inventory method gives a company more control over the inventory it stores. A company that uses annual cost of goods sold (COGS) as its basic for the ABC classification method stocks less of the A-class items identified as having higher annual COGS and stocks more of the B and C-class items identified as having lower annual COGS. On the other hand, a company that uses annual usage as its basic for classification stocks more of the A-class items because of their higher usage and less of the lower use C-class items. costs. Because the ABC inventory method makes use of Pareto's law, the basic 80-20 rule, companies can focus on containing the cost of the 20% of the items that make up 80% of a company's annual spend. Once a company has determined which items fall into each ABC category, it can establish cost reduction initiatives at the SKU level. Improved service. One of the greatest benefits comes from the improvement in customer service levels and order fulfillment. ABC analysis provides a company with information to stock the right mix of inventory. Warehouse. ABC inventory extends to warehouse management as well. Companies utilizing ABC analysis in the warehouse give priority space to faster moving SKUs. The economic order quantity model considers the trade-off between ordering costs and storage costs in choosing the quantity to use in replenishing items' inventories. A larger order quantity reduces ordering frequency and hence ordering cost or amount, but requires holding a larger average inventory, which increases storage holding costs a month. An inventory-related equation that determines the optimum order quantity that a company should hold in its inventory given a set cost of production, demand rate and other variables. This is done to minimize variable inventory costs. The primary objective of a good inventory management system is to keep the inventory costs to the minimum. The three major elements of inventory costs are as below: ordering costs, storage costs, cost of carrying inventory, stock out costs, cost of lost sales due to inventory shortages. Replenishment system. Under this system, the quantity to be ordered is not fixed. Instead, ordering time and the maximum stock level for each material are fixed. There are frequent reviews of the stock. The quantity ordered is decided based on the lead time of the material, maximum stock level and the stock health on the date of review. Fixed order quantity system. The quantity to be ordered is fixed under this method. Reorders are made once the stock reaches a certain predetermined level called reorder level. This is typically fixed based on the average consumption during the lead time plus some buffer stock. Two components of inventory costs that are considered in computing the EOQ, ordering cost and storage cost. With increase in lot size of purchases, the ordering cost decreases and storage cost increases. On the other hand, with decrease in lot size of purchases, the ordering cost increases and storage cost decreases. EOQ deals with striking a balance between these two factors. The following algebraic formula is used to compute EOQ, where C is equal to annual consumption of the material, O is equal to ordering cost per order, S is equal to annual storage cost per unit. The above formula has been derived as at EOQ, total ordering cost is equal to total storage cost, that is number of orders, X ordering cost per order is equal to average units stored X annual storage cost per unit, C by EOQ XO equal to EOQ by 2XS. Cross multiplying, we would have EOQ to equal to 2CO by S, therefore EOQ is equal to square root 2CO by S. The primary operation strategy and goal of most manufacturing firms is to seek a high satisfaction to customers' demands and to become a low-cost producer. To achieve these goals, the company must be able to effectively utilize resources and minimize costs. In manufacturing companies, when items are internally produced instead of being obtained from an outside supplier, the economic production quantity (EPQ) model is often employed to determine the optimal production lot size that minimizes overall production or inventory costs. The classic EPQ model assumed that during a production run, a manufacturing facility functioned perfectly. However, due to process deterioration or some other factors, the generation of imperfect quality item is inevitable. EPQ only applies where the demand for a product is constant over the year and that each new order is delivered or produced incrementally. When the inventory reaches zero, there is a fixed cost charge for each order placed. Regardless of the number of units ordered, there is also a holding or storage cost for each unit held in storage, sometimes expressed as a percentage of the purchase cost of the item. The required parameters to the solution are the total demand for the year, the purchase cost for each item, the fixed cost to place the order, and the storage cost for each item per year. Note that the number of times an order is placed will also affect the total cost. However, this number can be determined from the other parameters. Now in the end, let us summarize what we have learned in this lecture. Inventory management is an important part of a business because inventories are usually the largest expense incurred from business operation. The cost of holding goods in stock expressed usually as the percentage of the inventory value. It includes capital, warehousing, depreciation, insurance, taxation, obsolescence, and shrinkage costs. Inventory is a necessary evil in any organization engaged in production, sale, or trading of products. Inventory is held in various forms including raw materials, semi-finished goods, finished goods, and spares. An inventory control system operates on a technological basis. It updates automatically every time an item is scanned and removed from the inventory, so the employer knows how much is on location at all times. Inventory management system helps business orders inventory by accurately recording consumer sales. Electronic inventory system can track sales in a real-time format, ordering inventory automatically when current stock hits a predetermined minimum level.